The GameStop phenomenon, market mechanics, social dynamics, and the future of retail investing. In the annals of financial history, few events have captured public imagination and stirred the markets as dramatically as the GameStop phenomenon, an event that unfolded primarily during January 2021 but left ripples that are felt to this day. This saga, at its core, is a convergence of traditional market mechanics, the rising influence of social media, and a profound shift in the landscape of retail investing. Historically, the stock market has been perceived as the playground of institutional investors, hedge funds, pension funds, and the like, with retail investors playing a relatively minor role. This dynamic began to subtly shift with the advent of internet trading platforms in the late 1990s, but it wasn't until the 2010s, with the emergence of user-friendly, commission-free trading apps like Robinhood, that the barriers to entry for average investors were significantly lowered. This democratization of the stock market set the stage for the events that would unfold around GameStop, a struggling brick-and-mortar video game retailer. The saga began quietly in mid-2019 when Michael Burry, famously portrayed in The Big Short, disclosed a significant position in GameStop, predicting a turnaround for the company. However, the narrative picked up steam in 2020 when a group of retail investors on the subreddit Wall Street Bets began promoting the stock. These investors noticed that GameStop was one of the most shorted stocks on the market, meaning that many hedge funds were betting the stock's price would fall. This set up a classic David versus Goliath storyline: small, individual investors against large, institutional short sellers. The crux of the phenomenon, known as a short squeeze, occurs when a stock with heavy short interest starts to increase in price. Short sellers borrow shares to sell them, aiming to buy them back later at a lower price. If the price instead increases, short sellers are forced to buy back shares at higher prices to close their positions, pushing the stock price even higher. This is precisely what happened with GameStop in late January 2021. As members of Wall Street Bets piled into the stock and options, the price soared, leading to massive losses for short sellers and prompting some to close their positions at huge losses, further fueling the stock's ascent. The social aspect of this phenomenon cannot be understated. Platforms like Reddit, Twitter, and Discord became arenas where individual investors could collectively organize and amplify their impact. The narrative was not just about making money, it was framed as a crusade against the perceived injustices of Wall Street. Phrases like "hold the line" and "to the moon" became rallying cries. This collective movement, powered by the viral nature of social media, caught mainstream media attention, drawing even more participants into the fray. The GameStop saga also raised serious questions about market regulation and the role of brokerage firms. The decision by Robinhood and other platforms to restrict trading of GameStop shares sparked outrage and debates about market fairness. Critics argued that the restrictions disadvantaged retail investors and were meant to protect institutional interests, while the platforms maintained that the measures were necessary to meet regulatory capital requirements and manage risk. In the aftermath, the GameStop phenomenon has been dissected from multiple angles. For market regulators, it highlighted the need to reassess rules around market manipulation, short selling, and the functionality of trading platforms during periods of extreme volatility. For the financial industry, it underscored the growing influence of social media and the collective power of retail investors. And for the individual investors themselves, it was a stark reminder of the risks involved in the market, as many who joined the fray late or held onto their positions experienced significant losses when the stock price eventually receded from its peaks. The GameStop phenomenon is not just a tale of financial markets but a narrative about the evolving nature of collective action, the democratization of investing, and the unpredictable interplay between technology, social dynamics, and traditional finance. As the market continues to evolve with technological advancements and shifts in investor behavior, the lessons learned from the GameStop saga will undoubtedly continue to inform discussions about market structure, regulation, and the empowerment of individual investors.